Hi, folks. This is Sean Hyman, and I wanted to talk to you about high probability, low risk trades and how to find them. When a trend is really heading one way, whether up or down, when it starts getting kind of long in the tooth and extended, if you hop in along the way, you run the risk of a deep correction before the trend heading on, and so it's more likely to hit your stops. It's more likely to scare you out, margin call you out, stop you out, whatever. And so there are high probability trades, and that can move very quickly, and they can also have you in the market less time and making a larger return with lower risk and higher probability. And that is finding trades that have built a base. In other words, they have range traded for a while. Maybe they formed a rectangle like we see here and like we see here, or maybe they formed a descending triangle like we see here. Again, an ascending triangle, a descending triangle, or a symmetrical triangle are all consolidation patterns. It doesn't matter which. It does as far as where you're putting your lines, but that's as far as it matters. All of them are consolidation patterns, base building patterns for which the next big breakout and directional move to launch from. Also, a thing to remember is lower volatility begets higher volatility. Ranges beget trends. Directionless moves beget very strong directional moves. So you can look at it any one of those ways, but they're all really saying the same thing. And so a lot of traders will look at a move like this and go, well, that's kind of boring. It's not really doing anything. It's just a ho-hum pair, and I don't want to be in that pair. But really, I would encourage you to have some charts up on a screen that are range bound, and that you've got lines drawn on that contain the range, and watch for one of those to be solidly closed beyond, because that is your trigger and for the trade. And the nice thing is you don't have to figure out whether this trade is going to break out to the north side or the south side. You simply let the market tell you which that will be. And so as this ranges, you want a good solid close and the pair to be a distance away from the actual range to where it's a for sure solid break below all previous lows, and it's more definitive. That's when you hop on. In this case, you would hop on short. This happens to be a EuroCAD chart, daily 1-year chart, but you can do this on any pair that you find a range on, and you can do it on any time frame. So you can do it on 1-hour chart, 4-hour chart, daily chart, whatever. And so the pair breaks out into a huge directional move, and so you get to take advantage. You get to hop on the train when the train leaves the station, not hopping on the train waiting for it to depart, is basically what I'm trying to say. So the chances of a huge pullback back into the range are slim, and a huge move in your direction to get you quickly into profitability are fairly large. Then once you move into profitability enough, you can take partial profits on part of the trade, or you can move your stop up just past break even to make it essentially a riskless trade. Several things you can do, but it affords you the right to to protect your profits and protect against loss, which is one of the biggest names of the game right there. And so here EuroCAD is again consolidating up, low volatility. One thing we know for certain is that this will beget high volatility. We don't know when. This chart could, and you can see right now it's pushing the upper end of this, but it could wick above it and come back down into it. So again, there's no distinctive close yet beyond it, but this could go on like this for days or weeks or months. Of course, the smaller the time frame you go down on an hourly or a 4-hour chart, of course, breakouts will happen far sooner because each candle covers a smaller amount of time. But one thing is for certain, whichever way this breaks out, and when it does, it will be a very decisive directional move, and will be a high probability trade that will not take generally a huge degree of risk. And I would say these patterns, these breakouts from these patterns are about 80% successful. I'll say they'll fake you out probably about 20% of the time, and a lot of the times when they fake out to one side and come back in, the real breakout is usually on the other side. So they're very reliable patterns. Another one over here is Aussie dollar. You can see that this has had a huge directional run up, and at a certain point, as it continues to run up, it gets very risky to get in this trade because you risk a huge pullback. So imagine if you got in this trade and you got in up here and it goes up a little bit further, then it has this huge pullback before the next advance, and that's what I'm referring to. So the best thing to do is to wait for a large consolidation to occur, typically in a rectangle or one of the three triangles mentioned, symmetrical, ascending, or descending, and then wait for a breach of that, a solid closed candle beyond the barriers of the range. And then once that happens, you have your direction, and you know that in the upcoming, since this is a daily chart, in the upcoming days, this is likely to propel very much, the trade would likely go very much in your favor, depending on which way it breaks out and you hop on. And so there's usually very little delay because all the delay time was caught up within the range. So you're in the trade when it's actually doing something. You're in typically a lower risk trade because it built a base from which to launch out from. And the reason why these patterns work from a practical standpoint is because imagine this trade being in here. You've got people long and people short. You've got people betting that it's going to break out higher, and you've got people betting it's going to break out lower. Well, the shorts, they have stops clustered around up here on the other side of the range, and the longs, the people that have bought and expect this thing to break out higher, they've got stops towards the bottom end of this range, below it. Well, when there's a solid breakout through it, it delves into a big patch of stop orders that is like fuel to the fire that fuels that trade and gets it distinctly out of the range. And then from there on, once you've busted through a bunch of stops, more and more people have suddenly realized they're on the wrong side of the trade that were long, and so the ones that weren't stopped out will usually have to reverse their trade or get margin called out, and that fuels yet another round of selling in this case. So there's a practical reason why these happen, but look for the ranges, whether rectangles or triangles, define them, and sit back and be patient and allow the market to tell you which way it's going to break out. Remember, you want to see a closed candle beyond a solid close, in other words, distinctly beyond the range. And so that doesn't matter if it's on a daily chart like we're seeing here, or if that's on a 4-hour or 1-hour chart. If you're on 1-hour charts, you want to see a 1-hour candle close and a new candle start that is well outside of the range that has been defined before you hop on the trade. So the beauty of it is they're high probability, low risk. They tend to work out about 80% of the time in my past history of just trading and seeing them and watching them. And you get a lot of movement in a short amount of time, which is good. And so, having a huge recoil back on you is fairly rare. Also, you can expect the pairs to move minimally by the amount of the width of the pair. So you can measure the width of the range, the widest portion of the range, and whichever way it breaks out, you can extend it away from that. So that probably is for another whole video, but there's price targets associated with that as well. So look for ranges on different time frames, define them, and sit back and wait and be patient for the trade to show you which way that it wants to go, and then hop on. Thanks so much for watching. God bless. Bye-bye.